From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, April 1st. You're listening to the Macrocast. It's Tony Fratto. I'm in Washington, D.C. today with most of the rest of the crew, Matt McDonald, John Fagan, Brendan Walsh, and then from Pittsburgh, John Dick is with us today too. And Matt, it's April Fool's Day, but there was no fooling around with the jobs report today. It's pretty pretty solid.
Your kids may be out of the house, but you're still a dad, Tony.
Exactly.
The jobs report came in at 431,000 jobs in March. The unemployment rate is down to 3.6%. Labor force basically everything in this jobs report is pretty good and a little bit more. It continues the trend that we've seen. This is 12 straight months now, a year of 400,000 plus jobs per month, which is pretty awesome. The number itself is a little bit below expectations, but nothing to kind of change people's minds about stuff. Revisions over the prior months were up almost 100,000, which is really solid. Wages over the past 12 months are increasing at 5.6%, which is really high, and definitely contributes to some of the inflation conversation we've been having. The labor force participation rate is up to 62.4%. That's still a point behind one. That's now 1 percentage point behind where we were prior to the pandemic, but we continue to make gains there. One interesting kind of nugget in the report is that actually, when you break it out by demographics, almost all the unemployment rate declines are driven by gains for women, which is kind of interesting. There's been some studies recently on kind of there was discussion that the pandemic hit women particularly hard. And then there was a recent paper that said that wasn't actually the case. It was kind of maybe more of a pain in the butt for them, but that there wasn't any kind of particular outsized impact on jobs. But nonetheless, they've had a good jobs report in March. So that's that's the highlights and the updates. I think that all in all, it's a good report. There's no asterisks. I think it pretty squarely turns the question to the Fed. There's not going to be a lot of navel gazing on the report or what it means or that sort of stuff. It's a confirmation of what we've seen over time.
Yeah, I think you mentioned on the wages, Chairman Powell the other day talked about the super tight labor force and this idea of a wage cost spiral feeding inflation, and that wasn't confirmed in the report. Kind of saw, like you said, I think you said 5.6%. Matt, yeah. Obviously, inflation's running hotter than wage growth right now, but if you were going to see wage push inflation, you'd see wages starting to push against, above the inflation rate, pulling the inflation rate rather than dragging the inflation rate, which seems to be what could be happening as the economy goes through its shifts. John Fagan and Brendan, my initial thought was Powell was signaling to the markets that you should be thinking about 50 basis points shift in the policy rate rather than 25. And do you think this report confirms that or pour some water on it?
Yeah, I'll let John speak to it because he was the one that made a good point on a call we had the other day. But we do have a very interesting dynamic where markets actually could be influencing the Fed's confidence in doing a 50 basis point hike.
Yeah, it was a piece we wrote called Green Means Go. And it was, after the week after the first rate hike since December 2018, the equity rally began, and we had really chunky gains in the S&P 500, and that, I think, given my experience, I think probably yours too, validates this. policymakers pay attention to these signals, and probably the equity market, if anything, gets more play inside the policy the policy decisions than maybe it should. But the positive aspect and upturn in equities, I think, has given the Fed the green light, and they're taking it. I think that the market will. The market is absorbing their more hawkish tilt over the last week with the 50 basis point put up, and that gives them the leeway to continue down that road. And they're going to basically, the shorthand way of saying it is the Fed's going to take all the rate hikes that the market's going to give them. And we saw again the Treasury market, though the bond market is giving a different signal. And so today, the equity market is up again. It's obviously, heartened by some of the discussion about potential diplomacy. Again, that's a tantalizing prospect that keeps sort of bringing the equity buyers in. But what was the reaction in the Treasury market to this report? The yield curve inverted. And when we talk about the yield curve, it's the 2s, 10s. That's the most watched part of the yield curve. Everybody has their favorite part of the yield curve. You might look at 3-month, 10-year, and that sort of stuff. But 210 is the kind of classic, and that was the response to this really delightful number this morning. Was a great big raspberry from the Treasury markets, unfortunately.
The interesting part about the yield curve is, so the 10-year is at 2.43, the 20-year is at 2.68, but the 30-year is at 2.52. What insight does the market have for that decade? Is it going to be just terrible in 20 years?
Well, that's the question I have. I mean, what is it really telling us? It's been. I know it did technically invert, but it's been flat. It's been relatively flat for a long time. But what is it telling us about the future?
I'll give a pitch on what it's telling us. I think that one way to think about the yield curve inversion is that the markets believe that the Fed is serious about getting inflation under control, and that their confidence in the Fed being able to do a soft landing is low. That's what I think it says, which is not.
I think that's, absolutely right.
Which is not, to be honest, I'd rather have it that way than the other way. So
is that, let's say that again. So you think, they believe the Fed can get inflation
inflation is interesting right now because it is not just a phenomenon of like monetary policy. And so it is not completely under the Fed's control, right? Like you have a lot of factors, including geopolitical and supply chain, and who knows what exogenous shock will greet us next month. I'm sure there'll be something. Yeah. My point is that the yield curve being inverted is a vote of confidence that the Fed is serious about getting inflation under control, and simultaneously a vote that the markets don't think that the Fed will be able to engineer a soft landing. That's what I think it says.
So they'll get it under control the way they have frequently
the hard
done
way,
in the past, which is
putting us into recession.
Some kind of a recession, even if it's a mild recession.
I think this is a really interesting dynamic because if I watch the news or look at Twitter, I would think we're in a terrible recession and the world is coming. But when I go outside and see actually people, it's a boom town. Like everyone's having a blast and doing things and spending money. John, like what are you guys seeing?
Living your best
have this
life,
dynamic
Brandon.
Where we're very mad about inflation. We don't like the president. We're mad about the war. But then when you go outside, you go to a fancy restaurant and have fun.
Any kind of restaurant.
Yeah.
Yeah, I mean, look, the consumer just continues to be incredibly resilient with their spending. There's two stories. Sort of the lower income households are facing a lot of stress to manage their expenses and such. And you've got sort of upper echelon income groups, maybe a little worried about retirement, but spending across the board and we're seeing it, as expected. Experience spending is on the rise. Consumer goods pretty much flat. I mean, they're flat because prices are up and overall sort of basket size is down, and it sort of nets out to the positive. But yeah, I mean, look, the ESI this week was just the third consecutive record bad week or bad reading. So that's like 6 straight weeks of negative reports from the consumers. But the one thing that really jumped out at me was the one indicator that climbed pretty dramatically over the last 2 weeks was just 6-month confidence in the economy 6 months from now. So I think the consumers,
that's really interesting,
starting to feel a little bit like maybe we've hit the bottom. And so they're seeing maybe gas prices kind of stabilize and drop a little bit.
Yep.
Maybe they're less sort of freaked out by what's going on in Ukraine. COVID has completely lost its grip on our psyche as a group, which is, in many ways really good because people are starting to, report significantly higher interest in going to major events and concerts and all those sorts of things. I mean, while it may look sort of bleak in this really small moment in time, I think the consumer feels like better times are on the way. Hopefully they're right.
Yeah. And that's the interesting dynamic for the Fed, where inflation is high. It's high for a whole host of reasons. But even if you take the inflation aspect out of it, the economy is doing quite well. And we really shouldn't have rates at basically 0%. We have to begin the process of normalizing it. It's just how quickly and how high we end up in the end.
So what do you think they do? I mean, I kind of felt that it does take 50 basis points off the table. That there's no reason to go 50 basis points if from the wage signals. But what do you think? I mean, do you think that they do it just to knock it out and get Larry Summers off their back? And
I think essentially that's right. I mean, I think at this point they are trying to get in as many rate hikes as quickly as possible. They do feel an urgency. It's pretty clear. They've all but admitted that they are behind the curve. And so when the market gives them the rate hike, and we're seeing futures markets pricing in a very high likelihood of 50 basis points at the next meeting, and the Fed is not going to come in underneath if they feel like the market's going to give it to them, I think is our take. And certainly when you look at financial conditions, tightening interest rates are only one part of the equation here, as we all know. And the equity market rally, the kind of storming equity market rally that we've seen, has loosened up financial conditions, and the Fed is going to work against that. There's one of the ways that people have put it over the years is, hey, the Fed has a put underneath the stock market, which means, if it goes down a certain amount, the Fed's going to ease and take your downside risk. This is kind of the opposite formulation, which is the more the equity market gets frisky, the tighter the Fed is going to go, because they feel like, they're working against that easing of financial conditions inherent in risk appetite.
Well, Matt wasn't making his own prediction. He was saying what he thinks how the market is interpreted, or what the inverted yield curve is expressing about what this sort of aggregate view of the markets. But do you think that that's essentially, are they right then? I mean,
I think that the issue for the Fed is that there are, as I alluded to before, I think there's just a lot of dimensions of this that are somewhat out of their control. And I think they've kind of run out of runway to let those issues resolve themselves. So
it just seems to me, though, that on that point, I agree with you, Matt. I totally agree. So I say, well, then why are you going to go 50 basis points, right? If we're saying that, they feel like they have to do 50 basis points, the market's absorbing it. Oh, and this is all going to end in a recession because they're going to overshoot. It's like, don't overshoot.
Well, but here's what I would say about that is that to the extent that some significant rate hiking now has a cooling effect on the economy, right? So people who are going to come roaring into the home buying market this spring or summer are looking at rates and thinking a little differently and that sort of stuff. That may buy more room for the supply side to correct some of the problems over there in ways that I think the assumption that you're making on that, Tony, is that it's like, okay, we're looking at a continual rate hiking cycle over the rest of the year. I think what they don't if they see softness, there's nothing to preclude them from pausing. I guess it was John's point. I just don't think they want to be behind the curve. And I think that they feel like they're behind the curve now.
They are. There's no question that like they are in fact behind the curve, right? Like if you see inflation running as hot as it did, their job is price stability, and inflation exceeded the top range of their expectations. So there's no question they got behind. What I get uncomfortable with is sort of and it's like, it's not just us on this call. Like when I watch CNBC and people talk about is that there's sort of inevitability to their decision making, or an inevitability to the outcome. And I just think there's no inevitability. Like you can change your mind. You can
totally.
See what and like,
but I'm saying that, I mean, there's like the Fed's position on this stuff is super interesting because they are both managing the Fed manages their own actions. And then they also actively think about and manage the actions of the market, which is their counterparty in some sense. Mm-hmm. Right.
Yeah.
And so I think John's point is right, is that they want to get further ahead of where they are on interest rates, and the market's going to give it to them and they're going to go that way. I think that if they feel like, their management of the demand side is bringing demand and supply and the supply side and the supply chain impacts that, you've got shutdowns in China and that sort of stuff. If that stuff gets them a little more time and can meet up with where the demand side is, I don't think it's necessarily, I don't think that it is determinative that you have an exceptionally long rate hiking cycle, or that it's like, 50 basis points and then 25 and then 25 and then 25 and then 25. It's going to be data dependent, as they say.
Yeah. And I think that's a really good point. And I think that the Fed is looking at their, the hard landing risk that the market is interpreting and projecting with the yield curve. That isn't the first rate hike or the second or the third rate hike. That's further down the rate hike cycle. And so I think front loading, and I think the Fed sees it this way, front loading with 50 basis points for the next two meetings gives them optionality.
Yes. And here's the thing about the dual interpretation of the markets that I would say, in terms of like, they have confidence that the Fed is going to get inflation under control and low confidence that they're going to get a soft landing. The getting the inflation under control part has to come first, because that is literally kind of a credibility question. It's not a competence question, right? The competence question is the soft landing. So I think from a Fed perspective, if I'm the Fed, I would take that market perception and pocket it and say, yes, I have credibility to get inflation under control. And then for the soft landing, you'll just have to see how I handle it.
Though interesting today, to kind of push back on the 50 basis point, there's only a few Fed presidents that you listen to, but Charlie Evans is one of them. And he said this morning that he thinks that we should do 6 25 basis point hikes this year and a few more the next year. But he was very specific in his words that each one should be 25 basis points. And I don't think that was he knew what he was saying. He was pushing back against the 50 basis points.
Yeah, it's like the meeting is beginning of May.
Yeah, May 3rd.
Yeah, well, that's right. Yeah. It is a May.
Yeah, they've got a May, June, July gauntlet to run, and then a pause, and the next meeting's in September.
Well, so there'll be a lot more data between now and then, including another payroll report. So
when it comes to inflation, I mean, talking about the way that the consumer is absorbing it, you mentioned, John Dick, that the resilience, the spending resilience is there. Gasoline prices may have stabilized. What are some other ways in which consumers you can see in your work, consumers interacting with this inflation phenomenon?
Well, I mean, again, it's sort of a mixed bag depending on sort of household income thresholds, but as I said, we're kind of seeing a shift toward experience spending, which is a combined sort of, yes, people have money and people are less concerned about COVID. There are small little cracks we see, like people maybe a little less willing to take long road trips for spring break because of gas prices. one in five remote workers are saying that gas prices are giving them some pause about going back to the office. Just sitting in rush hour, I guess, and, burning a bunch of fuel. But those are just really things around the margins. We're just still living off, $1.5 trillion of increased household savings, and that gives people a long, long runway. The job market number we track in the ESI, which essentially asks people, is now a good or bad time to find a job? Mm-hmm. When it's sort of ironic a bit, because when that number goes down, that might actually in some ways be a good sign, right, for the economy. If people feel like it's getting harder to find a job, that means more people are looking or going back into the workforce. We're seeing it in the service industries, right? Like people are getting back to work, and it's raising the competition level across the workforce. And I think people are starting to feel that as well, which again, maybe right now it sort of drags down the ESI number, but as a leading indicator of, like employment 3-6 months from now, I think it's a positive sign.
Yeah. I won't feel, I would love to see sort of workforce participation get back up around 63% and north before you start feeling really good. And there is runway there to your point on that.
This was a bigger dynamic during the fallout from the financial crisis, but it's worth pointing out that the labor force participation rate interacts with like demographic trends over time, where this is like year 2 of the pandemic, and incrementally as that goes on and you get aging population and that sort of stuff, it can be harder to climb out of some of that stuff. I would say it's worth saying I'm a great resignation skeptic personally, but I would say that one thing that's really nice about a tight labor market that I hope that everyone takes advantage of and that the economy benefits from in the future is that it's a great career switching time. Like it's a great time to, and from in a period of seems heavy societal introspection about how they're spending their lives, it's a good time for people to say, oh, you know what, I really want to be doing this. Companies will give a look to people who might not have the perfect credentials. And so like that realignment of people wanting to be doing stuff and being in the right career for them that might be a better fit and ideally more, from an economic perspective, more productive over time. That's always a good angle on this kind of very tight labor market, aside from people, getting jobs and getting in on the labor market who might have been relegated to the sidelines for other reasons in the past.
Yeah, I've been training to be a UFC fighter. It's going well.
Matt, I'm 100% with you on the quote great resignation. It was always just more maybe like of a great sabbatical for a lot of people, right? I mean, these people weren't retiring. They left the workforce under different circumstances. Yeah. You mentioned the return of women to the workforce, which we definitely see in our data. One of the things that drove that was, yes, women did leave the workforce at a higher rate than men early in the pandemic, because quite frankly, like we still live in this world where women are making 80 cents on the dollar compared to men. And in the early days when kids didn't have kids didn't have school and daycare options, and it wasn't a coin flip for families, right? So we just saw, but now, and so a lot of families got pretty comfortable, or at least sufficient, living on maybe one income, and that's sort of been getting eroded a little bit right now. That could be one of the inflationary kind of impacts of it, which is why we're seeing sort of some of those demographic shifts in the workforce in the near term. Young people are fed up with working remote. Like the least happy people we study overall job satisfaction. The least happy people in the workforce right now are young people who are still working remote. Like they're ready to get back into the office and have the socialization. And so that could cause a lot of job shifting, right? If I can get work for a company that has more of a hybrid or even sort of an in-office culture, like you might see even more young people shifting that way, which is counterintuitive.
Yeah. I mean, you see it at HBS. As soon as the mask mandate went away, all the 20-year-olds came back to the office and they're really happy to be there, Yeah,
it's good. It's good. It's a good look. And I think they are enjoying it. But on the women part of it, though, I think there's just a lot of structural stuff in there too, though, so that, women are mostly caregivers of children, and childcare options were diminished. Schools were closed. And then if you look at the professions that had the biggest employment hits, they were, hospitality, they were home care, nursing, teaching, all professions that are highly skewed towards women. And so it wasn't about so much women are making this choice. It's like the choice was being made for a lot of women in a lot of ways that were kind of beyond their control. And I do think you're seeing that come back. So you see, go to a hotel, and 70% of the people who you're going to interact with who work at the hotel are women. And you're going to see that, so you're seeing a lot more of that. You see it in airlines, you see it in restaurants, and certainly in places like childcare, elderly care, home health care, all of those professions that are going to start coming back, especially as COVID recedes. You see them coming back, and I think you're going to see some of that rebound in women working.
I don't know if it happens at a large enough scale to like make a dent in the job numbers, like national job numbers. But the other phenomenon, which will be interesting to watch over the coming weeks, is in corporate America at the end of the first quarter, when people's bonuses from last year get paid out, do we see a lot of shifting and shuffling in corporate, big brands, big marketing companies? Do we see a lot of senior executives sort of moving around and looking for new opportunities or whatever it might be over like the next 60 days? That'll be an interesting thing to keep an eye on.
Are you signaling that you've got plans, John? Or
Not at all. Not at all. I love my job.
Hey, one last question on this segment before we do a look ahead is anything going to make Americans happy though, John? Like, so we just talk about like this, like the job market remains really strong. We think maybe inflation's moderating. Is the president is promising to release 180 million barrels of from the Strategic Petroleum Reserve, but like their financial and economic situations are pretty good. Opportunity to get a job is great. The ability to sort and go to happier jobs, as Matt noted, is probably, I don't know another time. You probably have to go back to the 60s before you saw something like that. It's like, and yet they are, as you noted within the ESI and every other report, as angry and upset as they've ever been about anything. Is there anything that can make them happy?
Well, I mean, COVID going away, staying away, stabilization and risk, shrinking of gas prices will certainly help. It's hard to discern right now how much of this is clouded just by politics. The only person whose approval rating has fallen more in the last couple of weeks than Joe Biden is Will Smith's. I mean, we're like for maybe it's a messaging problem or I don't know what it is, but like the perception of the administration right now to like guide us through this is like abysmal. And so we see a great jobs report, we see good consumer spending numbers, but like people still are so focused on the negative. I mean, I don't know what's going to make them. What's that?
Polling recently, political polling has indicated that like inflation is just kind of issue 1, 2, and 3, and that all the rest of it is, it's stuff that we talk about.
Right. But it's also too, I mean, but what's weird about it is like, it's not showing up in consumer spend. Like people they're going to restaurants, like you said, Brendan, they're traveling.
It's a fascinating dynamic. We're angry, but we're also happy.
It's purely psychological. I mean, it's just really this like psychological thing. It's almost like an irrational, because they're seeing inflation in the news and they drive by every gas station and the prices are $4+ or whatever, but it's just having this psychological impact that isn't actually manifesting itself in behavior, which is, it's really
one question I would love to see, John, if you, I don't know if you asked this already, if you would consider getting it in your mix, is just the question as to whether a consumer is substituting for a lower priced item, which would be kind of an interesting indication. Like, so have you made a decision to like buy a generic, or have you made a decision to buy a lower priced substitute? I don't know if you can get the wording right, but that's the thing that you're looking for, in this, that old saying that, the greatest cure for inflation is high prices, right? Because people start making choices to either not do things. You mentioned about driving, we see some evidence of that. They buy store brand products rather than brand name products. They don't buy the expensive model of the car. They notch down to the, a middle range car, things like that. All of those things are the things that depress pricing, because they're making consumer choices.
Yeah. Well, so I don't know if we track it exactly that way. One thing we've watched happen over the last several months is how supply chain dynamics have changed, like brand loyalty among consumers. Because if the thing I'm looking for on the shelf, and that's actually driven a heyday for like private label store brands, like that's like a big boost for, but so it's something we could look into, but I'll tell you what's not happening yet, which we would have expected to start in a normal inflationary period or whatever low economic sentiment period, is we're not seeing brands drive a lot of like discounting and couponing and value. You'd see that like a canary in the coal mine of that would be like in the QSR category. You aren't seeing a lot of like value menu emphasis among marketers in those areas, again, because like they're saying, I don't have to yet.
Let's take a break and come back and take a look at next week and see what we have coming up. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The CivicScience Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the Macrocast. Guys, what do we have coming up? Matt, what do you have coming up?
Hype announcement for next week. We recorded a podcast interview with Nick Timmerhouse, the chief economics correspondent for the Wall Street Journal, Fed beat guy, on his new book, $1 Trillion Triage. It's the first cut of the history of the Fed response to the pandemic. And it was a really interesting conversation, both getting inside the room of how they dealt with it, and then kind of a little bit of the the consequences today and how they're thinking about it going forward. So definitely that'll show up in the podcast feed. But
definitely look for that. Nick is he's just one of those really terrific storytellers. Like he's a really economics writing and reporting can be very, very, dry. He tells his reporting is always worth a read. And
just a tidbit too. There is some new reporting in the book, but one of the things that he talks through he talks about some of the processes and scenario planning that they had in place before, but there were programs that they left on the shelf in case they needed them. So it's a pretty fascinating read into that period of time.
When's that being posted, Matt?
I think it's coming out Tuesday, but
okay.
Don't hold me to that.
We'll look for it. Any data next week, Brendan?
It's a little slower because today is April 1st. The jobs day data came out today, which normally would have been next week. We have some trade data, global trade data. The RBA, Royal Bank of Australia, has a meeting, but nothing too market moving next week. It should be a quiet one.
Okay. All right, guys. Great show. Great Jobs Day. John Dick, great to have you with us on Jobs Day.
Great being with you on Jobs Day.
Well, have a fantastic weekend. Lots more to look forward to next week. We'll see you on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.